We are going to have some fun today and look at a case study of a 35-year-old individual taking out a high cash value life insurance policy, a whole life product, but he's interested in the cash value, but what he's really interested in is seeing how he can use it to buy himself a supercar. When I say supercar, I'm talking a real supercar. We're going Ferrari, Aston Martin, something nice. If you know me, you know that I like cars quite a bit. I used to have a very nice sports car, but I got rid of it for the main reason that I didn't want it to seem like I was showing off. I just felt weird driving it all the time. So my wife and I have SUVs now, which we are very happy with. But I still like cars. I still like looking at them. Definitely like driving them. If you have one and you're ever in town, I would love to check it out. But aside from that, let's get into the case study and have some fun. What we're going to really look at in this case study is the 35-year-old individual, first and foremost, maximizing the cash value of a policy. And really what to look at. He wants to see the guarantees, current dividend values, an indexed feature as well he wants to see. But then how does he use that money specifically when he goes to buy his supercar, which we'll see what he's looking to purchase throughout this video. But when he goes to purchase it, he asks, hey, what does it look like if I buy this car and I don't pay the loan back? What if I only pay the interest? What if I pay it back in full? What is the difference? So let's have some fun. What we'll begin with, so we've got a 35-year-old male. The initial funding, he's looking at $50,000 per year for 5 years. So that's $250,000 going into a policy. Now, the design of that policy is set up in a manner where he is not committed to $50,000 per year. So he's got $50K going in for the first 5 years. However, what he is billed for each year is approximately $5,000 per year. So we designed it in a manner where his minimum commitment is $5,000 and he can throw up to a total of $50K per year at his discretion. This example, these models will be with a very flexible company, one of the big four. Now, after the first 5 years, he says, I want to continue to feed this policy, but I don't want to keep funding it at $50K per year. Maybe if I've got the means to do so, but I've got other plans with my money. 50 for 5 is what I'm comfortable with, Steve. But after that, let's say I pay in $10K per year up until age 65. So we modeled that. And what I also let him know, or I'll let anyone know working with us, is in a case like this, where you're funding a policy with a lump sum perhaps, max funding over 5 years, and then cooling down on the funding, you can stop after 5 years. You could stop after 10 years. You do not need to declare the funding period up front. We need to declare or set the minimum premium, the MEC limit up front, and we've got more on that in our policy design videos. But if everything is designed properly from the get-go, in respect to the premium, MEC limit, or how we set that MEC limit, you have a ton of flexibility as time passes, where he might pay in $50K year 1, then $30K year 2, then $20K year 3, then back up to $50. You can be flexible in that respect. You're not billed for this huge amount every year. So purpose here, or what he's aiming for, whole life insurance policy with one of the major mutuals, Mass Guardian, New York Life, and Northwestern Mutual, maximum cash value. That is his goal. He says, hey, I'm interested in this because of the cash value. As I look at the cash value in these products, I see that it is a safe area to position money, meaning it's not in the market at all, continues to grow over time. If things are going very well in the stock market and the economy, I can expect the policy to produce between 3 to 5%. Net, tax-free, internal rate of return on cash value. If things are going very poorly, I can expect the policy to produce 3 to 5%. Not related to the market. Liquid, he can access it any time that he wants, and then also tax-free. The tax-free piece is huge. Now, I know I always state this, but I want to make sure I always continue to state it, is you can access that cash value tax-free if it is done so properly. It is possible to trigger a taxable event, whether that's through a MEC, whether we cash it out with a gain on it, if it lapses when we've pulled out more than we've paid in. We've got other videos that go into that, which if you need help finding them, I know we've got a lot on our channel. Feel free just to shoot us a note via email or make a comment in the comment section. So again, he wants to pay up to $50,000, but not be committed to it. He's committed to the $5,000 per year. What to look for? So this is general advice. If your goal is maximum cash value, the first year alone, with any type of policy, you should typically see between 80 to 90% of your payment in cash value immediately. Sometimes we'll see closer to 95% if it's a pure high early cash value product that credits more upfront and less long-term. But with products that are geared for strong long-term performance, typically between 80 and 90% is what we can expect to see, depending on the company, the product. I used to state 85 to 90%, and that was prior to the 7702 change, where companies have repriced their products, PUA fees have increased with some, so that's why the range is a bit broader now, 80 to 90%. Break-even points, typically between years 4 and 6, could really be years 3 to 6 from everything we've seen, and this is specifically since the change, the 7702 update. If you have an older product, then it's years 3 to 5. Here's what we're going to look at. So we're going to look at this funding specifically. Guaranteed rate, meaning based on the worst case scenario numbers, the guarantees, what does the cash value grow to over time? The present dividend rate, and then also an indexed feature. So it's not an IUL, it's a whole life insurance product with an indexed rider attached, and he actually has the option to switch back and forth between the dividend crediting rate and the indexed feature. And again, the plans for money, so we're gonna have some fun. The car that he's gonna purchase is either an Aston Martin, my personal favorite, James Bond, or a Ferrari. Cherry red, of course, and the tan interior is what I would want there. So one of these he's going to purchase, but on a serious note, as far as being smart with your money and such, while cars are fun, they don't produce much of a return. He is planning to use it for retirement and then legacy planning as well. He does intend to pay the loan back. He likes the idea of using this to purchase a car. Will he actually buy an Aston Martin or Ferrari with it? Maybe. It's up to him. You know, it's your money at the end of the day in these products. But here's what I want to touch on. So with the policy loans, we're going to look at the following. And this is good to see regardless of what we're using it for. Real estate, other investments, a Ferrari, whatever. What's it look like if I borrow and make no payments? Nothing toward the interest, nothing toward the principal. I just let that loan balance compound over time. Then what does it look like if I pay the interest only and also fully repay it? So we're going to take our time going through this. Before we look at the loans, first we'll look at just the funding and these guys. What does it look like based on these different assumptions? Let's take a look. We will begin with the guarantees. So this is one of the major mutual companies. You'll see right around 82, 83% cash value in the first year with this particular product. So here you go. Guaranteed values. Annual outlay. Years 1 through 5, let me get out of the way, $50,000 per year. After that, $10K per year, and you're going to see that paid up until age 65. Doesn't have to pay that long, but that's how long we're modeling. So cash value, again, these are the worst case scenarios, guaranteed values. What is highlighted in yellow represents his break-even point. So at year 9, he has paid a total of $290,000 into this product, and he has a total of $290,000. This would be his break-even point. We have the annual internal rate of return, and then also the average internal rate of return. The annual internal rate of return. Internal rate of return means it is the net growth rate we see on the policy. For example, the guaranteed rate with this company and product is 3%. Do we ever see this product produce 3% though? No. Anytime you see a guaranteed rate or a dividend for that matter, any crediting rate from an insurance company, we always want to keep in mind or have the awareness around the fact that that is a gross rate credited after the company's insurance expenses, mortality charges. So if you're interested in a high cash value policy and your plans to buy an Aston Martin with it, I still want to understand what the actual growth rate is. So I've got a gross rate, the guarantee of 3%, but as I look at it, first year, the minimum premium really is, that's the biggest hit right off the bat, that and the PUA fee in this example, negative 17%, that hurts. Now each year it gets better and better, but I'm not positive here on the annual growth rate until year 6. So to isolate this, what this means is if I look at year 5, I see negative 0.2%. Why it's negative is look at year 4. You had 183, you paid in 50, and it grew from 183.6 to 233.166. So you almost got the full 50K you paid in, but you didn't get 100% of it back. So in respect to your cash value, if you're really analyzing this stuff to make sure everything's set up right and you're considering, hey, I've got money in the bank that I have access to right now for opportunities or for a really nice car, or I'm going to put it here, what's the drawback? Up front. Now these are guarantees. The products have always done better than that with the major mutuals when they're designed right. But still, I like personally seeing a worst case scenario. Will it happen? Probably not, but I have awareness around it and the fact that it could, even though it hasn't for 150 plus years. Year 6, 233 to 246, and I paid in 10,000. So now I have a positive growth rate. And this is a non-MEC, so this is an effective tax-free yield, which is great. Continues to grow, gets close to 2% on the annualized IRR as time passes. And then I have the average on the right. Average is over 10 years, I averaged 0.27. Over 20 years, I averaged 1.27. Now we've got the dividend values. These will look much better. And this is good to look at, in my opinion. A bit more realistic. If you want to shoot it a little conservative, you could kick the dividend rate down and kind of go in between. But my point here, when I say looks better, I do like to look at actual data and what companies have actually delivered over time. So that break even between years 3 and 6 I mentioned earlier. Year 5, we paid in 250, we have 250. Annual IRR, much better. Going positive year 3. And specifically, that annual IRR means if I look at my cash value year 2, 90,744. I paid in 50. I got the 50 back and about another 500 bucks, a little bit more than that actually. But I see it grew from 90 to 141, backing out the 50 you've paid in as well. And I'm going through this very thoroughly. As time passes, year 6, pay in just $10,000. So this would mean of this $10,000 payment, $5K is still directed toward the base premium, which is coming back to work for you, and the other $5K is going into PUAs. The first 5 years, $5K is going toward the base, $45K is going toward PUAs, hyper-growing the cash value. Now, let's look at this over time, and what do you notice? Let's go down to the end of the funding. He's paid in what? 50 for 5 and then 10K all the way through age 65, the next 25 years. So it's a total of about 300 grand he's paid in. He's got about 1.2, and then he's got almost 700 based on the guarantees. I'm sorry, he has 700 at 65 based on the guarantees. Annualized IRR, about 4.56%, assuming the dividend rate holds exactly where it is. This model is run at 5.65%. Will that happen? Absolutely not. All companies adjust their dividend rates over time. You might see a dividend rate hold for a short period of time, for maybe 1 to 3 years. One company once did it for 10 years, but over the long haul, they do adjust. But here, we get a good indicator of that average IRR, a little above 4%. We always state that if things are designed properly, we should see a net IRR between that 3 to 5% range. Could do a little bit better. That's great. But I don't want to tell someone 4 to 6%, like I used to say a number of years ago, and then have it do between 3 to 5, 3 to 5.5. Like, no, you got to set expectations properly. So let's take a look also at this indexed feature. And we do have video content on this. I would just type in indexed whole life on our YouTube channel. And here we go, indexed values. You'll notice for the first 3 years, they are identical to the dividend values because the indexed feature with this company does not kick in until year 4, if we have it designed with a 1-year term rider to juice the cash value. But now I'm breaking even between years 4 and 5. A little bit stronger assumption rate as well. Very attractive on the annualized IRR. It's indexing though, so you're tied to the S&P 500. It's an assumption. It could very well happen. A lot of people like this. Some people don't like it. The good news is you do not need to select it up front. If you attach it and leave it at 0% forever, this indexed rider that is, it's the exact same thing as if you never had it attached in the first place. If you have it at 0%, there's no charges, no fees, nothing like that. If you say, hey, the market just tanked, I want to flip that indexed feature on, you can. You can change 1 time per year, or the adjustment takes place 1 time per year on your anniversary date, but we can switch back and forth. You can even go 50-50 if you want, or 70-30. You can blend as far as a portion of your money tied to this and a portion tied to the basic dividend. Not for everyone, but great to have awareness around it. And there's 3 states it is not available in. One of which is a state I live in, Pennsylvania. The other 2 are Virginia and New York, since 2016. So, basic overview on the growth. If we look at the age 65 value, he's got what? Almost 1.6 million based on the indexed assumption, 1.2, about 1.25, a little bit more in the dividend, and then 700 based on the guarantees. All of them, he's got more money than what he's paid in, which is great. Now, what about the fun part? Buying the car. So what kind of car should he get? I mentioned Aston Martin and Ferrari because I like the sports cars. They look cool, but maybe you're thinking Rolls-Royce, Bentley. Well, I didn't take a large enough of a loan to purchase a Rolls-Royce or Bentley unless it's used. Even an Aston Martin, you're getting advantage at best with this size policy loan. That's their low-grade model, $200,000 policy loan. So what we've got on the left is the basic dividend option. And if you say there's no way I'd use this for a car, this could be for a rental property. Right? So we can use our imagination in any way we want just to demonstrate what policy loans look like. So basic dividend assumption here. And anytime we look at policy loans, what I like to look at is the direct impact that a loan has on my policy. Meaning, if I don't touch the money, what does my contract look like as it just grows over time? Maybe I'm just using it for accumulation, leave money tax-free through the death benefit, all that good stuff. But when I take a loan out, what's the direct impact? So anytime, if you've worked with us, you know this when we've modeled loans, I love to show here's the growth model compared to the loan model. We provide the detailed illustrations, but also a spreadsheet, which is simplified compared to the detailed illustrations. You might say, this don't look simplified. Trust me, it is when you see the detailed ledgers. Here we go, though. So I do want you to keep mind or keep your attention on that dividend column as time passes. Break even year 5. Okay, this is great. Now, we take that policy loan out in year 5. This model is going to assume a loan and no repayment at all. This has a fixed loan interest rate at 5% and is a direct recognition policy. I know we go back and forth because we use both types of companies with direct and non-direct recognition, but this is a direct recognition company. The dividend rate is 5.65%. So when you take a loan against a policy, so in year 5 you had $250,000 in the example where you just let it sit and grow. When you borrow from a policy, what will happen with whole life insurance is you will continue to earn dividends and interest on the full $250 in this example, any money in cash value, and what you've loaned out as if you never touched it in the first place. With a small catch, direct recognition changes things a bit. Now we've got content on that, so I'm not going to go into full detail, but here's what I want to touch on. When we take a loan out, any money still in cash value, so we borrow out $200,000. The remaining cash value here is about $38,000. Now it was $250, so if I saw this and I'm not in the business, I would ask this question. I pulled out $250, why is it not $50,000 there? Like what's going on here? The reason why is this is an example where we pay nothing toward the loan interest. So there's your 5% cost to borrow. That's actually borrowed from the policy to cover the interest for me. And then also you're going to see a change in the dividends when I borrow. So back to the direct recognition piece, any money in cash value receives a dividend rate of 5.65%. That is this company's dividend rate. The money that you have borrowed from the policy, we're being billed what? 5%. We're not paying it, but it's going to the company. We are receiving a dividend on it. However, it's 5%. What the company does on borrowed funds, this is with this particular company with their direct recognition treatment, is they will match the dividend rate on borrowed funds. They'll still apply a crediting rate to the funds as if they were in the policy, except for they're going to adjust it to a rate that matches the loan rate. This way, they're not punishing other policyholders, a mutual company, everyone owns the policy company together, but what they don't want to do is punish the company as a whole. Now, if the loan interest rate is higher, it works out in a policyholder's favor. So if I had a dividend of 4.5% and I took a loan out, I would actually see that dividend rate on borrowed funds raised to 5%. So let's look at this guy as time passes. Earlier I mentioned keep your eye on that dividend column. So with what we just went through, when you take that loan out of $200,000, you're receiving a 5% dividend on that and a 5.65% dividend on the money still in cash value. So different crediting rates on different percentages of your money. Here's where you can see it. Year 5 dividend compared to year 5 dividend. See the difference there? 59.10 compared to 36.10. I've got less in this because I have a loan outstanding and there is a lesser crediting rate. Now we never touch this loan in this example. We never pay anything back. So it only makes sense that this pattern would continue. And it does. There's your difference. Now, we can look at this in a number of ways. We took out 200 grand and I said, I never want to pay it back. Show me what it looks like. I'll still keep on feeding the policy at 10K per year. And what happens? Well, your cash value still continues to accrue. The positive rate keeps building over time. You could say I've got more money than what I've paid in. If you really want to get technical in a case like this, and you're paying $10,000 per year, and you've got the choice to apply $10,000 toward premium and PUA payments, or I can stop paying any money toward premium or PUAs and apply the 10K toward the loan interest, that would actually yield you a little bit more money. And that's where it depends on the individual. If there's a chance they want to keep feeding the policy and address the loan at their leisure, then we would do this. But if they said, you know what, 10K is my number for the rest of my life, I'm not paying this loan back, what I would say is, hey, from a pure monetary standpoint, guaranteed and non-guaranteed, makes sense to apply that 10K toward the loan interest instead. Now, as an agent, that does not generate any renewal compensation for you, but keep in mind that it is in the client's best interest and you do not need to worry about any issues down the road like the policy blowing up or anything like that. Not that it will in this example either, but you can get more money out of it as far as maximizing the cash value and death benefit. So this was loans and no repayments. Let's progress on to paying the interest only. All right. Fun case study, right? What color would you get the Ferrari in or the Aston Martin? For Ferrari, I'd go cherry red. Aston Martin, I'd go like with a silver, like a deep gray silver, something like gunmetal, you know? All right, here's the paying interest only. Identical scenario. Look at this. Do you remember what the year 5 cash value was in the last example? When you took out that $200,000 loan and we paid nothing toward the loan interest? It was about $38,000. This example, we cover the loan interest. What do you notice? Look at that, $48,000. What I also want to point out is look at your death benefit. $1,050,000. What is it in the example where you just let it sit and grow? $1,250,000. So often I hear the question, why would an insurance company, or more so, how does an insurance company continue to pay you dividends on your entire bucket of cash value? The money's still in cash that I have not borrowed and what I have loaned out. Two ways. One, there is a cost to borrow, but the main way, they collateralize your death benefit. The cash value, view that as your equity or line of credit that determines how much you can pull out, but the death benefit is collateralized dollar for dollar. If you pay it back, it's restored, but we're going to see that in the next example. So here, there's the loan interest cost. Because we're paying the loan interest, this company actually provides a discount on the loan interest rate. It comes out to about 4.7%, might be 4.76, but you get where I'm going, you get a discount. And we pay the interest forever in this example. So, what's the difference at age 65? $1.267 over here, $969. How much did you pull out though? $200,000. So if you add 2 to that, you would have what? 1.17 there. This is almost 1.27. So there is a difference. Now the difference here, you can see it in the dividend column all the way through. The guy on the left was more all the way through because he did not touch the money. Higher dividend crediting rate, which is great. And why it drops down here, this loan interest amount, in case you're wondering why, is because this company drops the loan interest rate at age 65 to a fixed rate of 3%, which is nice. But still, we see the direct comparison. Now let's look at the good one. When I say good one, the one that makes the most sense, which is borrowing and then repaying in full. So same policy on the left. And by the way, why I have the IRRs here is anytime I'm taking a loan from the policy, I personally like to see what is the policy growing by, the net growth rate, and what is the actual cost to borrow. What am I paying in loan interest? This way, instead of just hearing, hey, it should be a wash or you should have a positive spread all the time, because that is not the case in reality. Instead of just hearing that, I can actually see it for myself, laid out on paper, cross-reference the detailed illustrations if I want with the Excel spreadsheets to make sure, okay, numbers are accurate, but is it in my favor or is it not in my favor? If it is not in my favor, what are some alternatives? Let's continue on. So, 200K loan. Look at that. In this example, we're going to pay the loan interest. So we see the $200,000 loan. Loan balance. There's my Aston Martin. Loan interest, we're going to pay that. And then we are going to apply $10,000 per year toward the principal payment. So one thing about policy loans is you can take your time. If you bought any type of car, can you take your time with paying it off? Or are you going to have payback terms? 5 years, 7 years, whatever it might be. Yes, you can pay it off early. In this example, we took our time. What we did was cover the interest expense and then applied $10,000 per year toward the principal. And what happens is as we chip away at that principal balance, we've got a lesser loan balance, so obviously the loan interest lessens over time. So our out-of-pocket decreases each year. What I also want to point out though is let's look at year 10. We are still funding the policy at $10,000 in premium and PUA payments. You're also paying $7,100 toward loan interest and another $10,000 toward the principal. So it's important just to provide transparency. Most of the time we know that obviously depending on our situation, but still, like I like it pointed out and laid out so it's very clean, easy to follow. Where I get frustrated with things is where I miss something and I think, oh, this person didn't tell me. Come to find out I overlooked something, like we're all imperfect, that happens. But at the same time, if it's laid out and it's very easy for me to follow, I don't have stress. I don't have the mental stress when I'm going through it. So as we look at this guy, when it's paid back, here's really what I want to look at. Actually, before we do that, look at your dividends. year 10, year 10. See the difference there? It's interesting, isn't it? And again, it's because when the loan's outstanding, the dividend crediting rate is not as favorable on outstanding dollars. And I forgot to go all the way down to 65. There we go. So everything's paid back. The example where I just let it sit and grow, $1,267,000. In this example, $1,210,000. About 50 grand less, a little bit more, which is significant. I would actually look at a cash value collateral loan in this case, which we've got content on that. But the point is, we've got a number of options. This is a great option for a high cash value policy for accumulation and the death benefit. So we wanted to see the legacy play. Let's go back to our growth model for that actually. If he kicks the bucket at age 90, what do things look like here? Guaranteed, about $1.2 million paid out. It's going to be more than that. Dividends, about $4 million paid out, and based on the indexed assumption, 6.3, almost 6.4. I'd probably peg it somewhere between, call it 3 to 3.5, and maybe 6 million or greater if they go with the indexed feature and it performs. That's tough to gauge over time because things change with that. But anyway, hope you enjoyed this one. I had a lot of fun, and whenever we talk about cars, I have fun. But anyway, if you did enjoy, please feel free to hit the like button, subscribe, and as always, I do hope this helps. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.